Caveman and his friend decided to open a coffee shop. Each of them had $5,000, which they decided to invest in developing their business. This money formed the initial capital of the company, which is called the authorized capital. With this money, they bought coffee machines, microwave ovens, refrigerators, and other equipment. In addition, they also needed ingredients: coffee, milk, sugar, and so on. Everything they purchased for $10,000 and used in the production process is called assets. They worked hard throughout the entire year, and by the end of the year, they earned revenue of $6,000. That seemed pretty good, but revenue doesn't show what expenses the coffee shop incurred during the year. Let's say the expenses amounted to $4,000. By subtracting the expenses from the revenue, we see that their profit was $2,000. Of course, they wanted to earn more. But to do that, they needed to expand the business. So they decided to take out a bank loan of $15,000 to open a second coffee shop. The first coffee shop had been opened with their own money, and that represented their equity capital. The second coffee shop, however, was opened with borrowed money and represented their debt capital. The sources of funding for assets are called liabilities. In this example, the liabilities consist of the founder's capital, $10,000, and the loan, $15,000. On the assets side, they now have two coffee shops with all their equipment. From this, we derive the fundamental accounting equation: assets equals liabilities.